Welcome to Coffee Chats with Klaas. Hi, I'm Eric Schwartz with Klaas Financial, and today I'm here with CJ Klaas to discuss a common question we get, which is how much should I be putting away for retirement? CJ, what is your take on this complicated question?
Well, of course, this depends on your specific situation and circumstances, but we'll do our best to narrow it down for you. First, there's three main variables to identify. Number one, how much do you currently have saved? Are you just starting out, or do you have a few bucks already stashed away? Number two, when do you want to retire? 55, 60, 65? This variable matters because it gives you an idea of how much longer you have to accumulate additional assets. Number three, how do you plan to invest your money? At the bank? Aggressively in your 401k, or more moderately? Here, compound interest will be your best friend.
What else should those planning for retirement consider when planning how much to save?
This is where your specific circumstances come into play. Most people's primary goal is to maintain their lifestyle as they transition into retirement. Said another way, people don't generally want to experience a drop in their standard of living when they retire. This is best accomplished by replacing 100% of your current net income. Now, net income is critical here. Your salary is gross income. Net income refers to what is actually deposited into your bank account after deductions are taken out, including taxes and insurance. This is a common error we see, not differentiating between gross income versus net income. You may be surprised to find your take-home pay to be only 50% or 80% of your gross pay after you account for things like federal taxes, state taxes, OASDI, Medicare, health insurance, 401k contributions, and the list goes on.
So, how would someone be able to replace 100% of their income if they're not working?
Naturally, we look to our investment accounts, but you should also consider other income sources, like Social Security, pensions, or rental income. If you have a clean balance sheet with minimal to no debt, you may be surprised how far these fixed income sources can go. It's also important to note that not all income is treated equally in retirement. Distributions from pre-tax retirement accounts are generally fully taxable at the federal level and may be taxable at the state level, depending upon your state of residence. But in addition, you may be surprised to learn that some or most of your Social Security may be taxable.
Why is determining net income so important, and what does it have to do with how much to save?
Because how much you save should depend entirely on how much you need or spend, which is why our recommendations can vary so greatly person by person or household by household. The individual who has nothing saved with no pension will have to save more. The individual who started saving early and retires with no debt will be able to save less.
So when are you going to tell us how much to save?
It's a good question. In truth, your required savings is best determined with a little help from a financial planner, or at least a financial calculator. If you must have a rule of thumb, consider starting with 10 to 15% of your gross income.
So CJ, what should someone do if they feel like they are behind on their savings?
Save more. All joking aside, this can be looked at in two ways. The obvious answer would be to save more or retire later, but consider someone who is, say, 5 years or less from retirement. They could focus on reducing their debt to free up cash flow. Having fewer monthly payments would arguably have greater impact than a few $1,000s more in savings. We often find that people planning for retirement focus too heavily on how much they have or have not saved, when in reality they should be focused on mitigating cash outflows, also known as eliminating debts.
Lastly, where should you save your money?
Generally, we recommend enrolling in your company-sponsored retirement plan, most commonly called a 401k or 403b. Even if the employer doesn't match your contributions. These plans allow for the greatest amount of savings per year. As of 2022, if you're under the age of 50, you can contribute up to $20,500 per individual per calendar year. And if you're over 50, you can contribute an additional $6,500 per individual per year as what's called a catch-up contribution, for a total of $27,000. If these plans aren't available, you can consider opening an IRA or Roth IRA. As to which IRA would be most beneficial for you, that's a whole separate video. And that's all for today. Be sure to join us again for Coffee Chats with Klaas.